I want to get your take on the U.S. China trade deal. Still some other things to be worked out, but the lowering of tariffs seems pretty significant. In your mind, does that increase GDP? Does that change anything about the markets?
So I think that the U.S. China discussions were in line with expectations. I mean, both sides had choreographed that they wanted a successful outcome. I think it's a fragile stability. I think it's important, not just the fentanyl tariffs, but that what China's doing itself, it's doing more stimulus as well. So I think you could see some growth upsides, not so much from the tariff rate, but one of the really good things about this discussion is both sides signal that they're going to continue the discussion with, state visits. Xi Jinping coming to the U.S., Trump going to China. And I think that will keep things on track so that we don't get much divergence. But I think this was pretty well choreographed. The purchases of soybeans, some relief on fentanyl, that on the more controversial issues, they weren't going to, they were going to get some compromises on rare earths and also on the chip exports. So this is one reason why I think China equities are a little bit lower. It's kind of a sell the fact because it was in line with expectations.
Okay, so you're not blown away by this deal. It was kind of in line with what you expect. Do you think it was in line with what the market expected? Why do you think futures are lower then? Is this about earnings? Is this about a similar setup, as you're saying, sell the news on the rate cut that everybody was expecting?
Well, I think the rate cut in the U.S., though, is definitely a hawkish cut. And I think the language that you saw out of the Fed basically saying a growing chorus, it really put December into question right now. So I think what you're seeing is just the market reaction today is, well, China, there was anticipation of this, but no big surprises. So that's been more of a sell the fact. I think on the Fed, we had thought that Treasury yields were probably about 20 basis points too low. And so you've seen a move. And you've seen a move on that. QT ended as we had expected, but I think the language that Powell chose was very blunt, saying that there is a growing chorus. The dissent also from Schmidt was a bit of a surprise. I mean, mirroring the 50 basis points dissent was not a surprise, but it does put December more into question.
All right. I want to play a soundbite from Jay Powell because you're mentioning his tone and you're calling it hawkish. I think a lot of people are. Let's play the soundbite and we'll talk a little bit about it afterwards.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
Why is that different than just data dependent? I mean, he said the same thing in different words. Maybe the tone felt a bit different, but every meeting he says we're data dependent. We have to see how the data plays out.
Yeah, but not a foregone conclusion.
But isn't that what data dependent means?
Oh, yeah, no. I think it has been language that is consistent with what he has said, but the dissent was more of a surprise. The growing chorus, I think, got a lot of attention. Is he speaking on behalf of the committee? And I think the other thing that we've really heard much more discussion on, it's not just the dual mandate on employment and on inflation, it's also the financial conditions. I mean, do we have financial conditions that are not restrictive and that's very clear so that the Fed has to be more careful? But I think the bigger picture is that we see growth revisions going up. So if you're looking at 3% growth in real terms and inflation around 3%, that's just not a recipe to keep on easing.
All right. What's your take on big tech earnings? Kind of mixed reaction. Alphabet, obviously the standout. Meta and Microsoft pulling back. Part of that is the charge, and our Sarah Coons put it great. Investors don't like surprises, especially not like that. Just what's your overall take, especially the increases to CapEx spending?
Look, the increases to CapEx spending, at least for the next year, are going to go on, just for what we see in the pipeline and also some of the incentives that are out of the one big beautiful bill that are going to help business spending. So I'm not surprised that you're going to see some sell-off here and there, but I think the trend is still one that is very much intact. And this is one where, honestly, the tech trumps tariffs. The market is more focused on that. And one thing we've taken a look at is really just the wealth effect that is being created out of this AI-driven CapEx. So we think that just the business investment in AI was probably about 1/3 of the contribution to global growth in the first half of the year, and that it added as much as $8 trillion to wealth. And that is kind of keeping the consumer going here.
All right. You may not have had time to calculate this or think about it too deeply, but tariffs from China on Chinese imports being reduced slightly, more CapEx spending on AI, which has been a driver for GDP. Does that change your GDP forecast?
I think we're looking at upwards revisions to growth that are coming up, and not just in the U.S., but Europe actually looks to have an upward revision. We've seen the same thing in China. And so I think that is meaning that is basically the storyline that we're going to see, more easing here from the central banks. There's more questions about that. Like, I think the ECB will remain on hold, which is where the expectations are. So we haven't necessarily, the slowdown that was anticipated, that is clearly something in this quarter where there's more upside risk than downside
All right,
risk.
Joyce, we got to go, but really quick, what sector looks most attractive right now after this gumbo of tech earnings, Fed cut, trade deal? What looks attractive?
Look, I still think that the defense sector, looks attractive here. I think the AI story will move on. Most people already have that, trade on as well. But, I think financials also, we didn't talk about financials, are going to do well here because you've got some of that deregulation and that is going to be coming up that will provide support as well.